Welcome back. Let's review the uncovered interest rate parity condition. It says that the dollar return to a dollar deposit has to be the same to the dollar return to a euro deposit. The term on the right is the expected rate of dollar depreciation. The nominal exchange rate with the E in the superscript, that's our expectation for the nominal exchange rate in 1 year. Then we have the US interest rate and the interest rate in Europe. And we're going to think of this equation as pinning down the nominal exchange rate today. And this is all in terms of dollars per euro, both today and the expectation over its value in 1 year's time. So before we can plot this, let's solve this for the nominal exchange rate and see how it relates to the interest rates and expectations about the future exchange rate. So I want to solve for this E. I'm going to move a bunch of terms on the other side. That's going to be the first step, and now I want to solve for E. These are dollars per euro. So then we get that the nominal exchange rate today will be inversely related to the interest rate differential between the interest rate in the US and in Europe, and directly proportional to the expected nominal exchange rate in 1 year. So using this, we can plot the UIP condition in the Forex market diagram. The Forex market will have dollar returns on the horizontal axis and the nominal exchange rate on the vertical axis. And so we're going to plot the nominal exchange rate as a function of the dollar return. So this is the dollar return to a US deposit and the dollar return to a European deposit, the entire right hand side. So what we've seen is that UIP will be downward sloping using this axis. So the way we want to think about this is that UIP is the dollar return to a European deposit, and that will depend on the exchange rate today. And at the same time, we want to think about the US interest rate determining dollar returns to a US deposit, and that being independent of the nominal exchange rate. So when these two things are equal, UIP holds, and this determines the nominal exchange rate today. So now the question becomes, how do we alter the diagram in response to changes in the given quantities? So here let's see what are the given quantities. So when we work with UIP or the foreign exchange market, we're going to take as given the US interest rate, the interest rate in Europe, and expectations over next year's exchange rate, or the exchange rate in 1 year's time based on our expectations. So now I would like to ask, how does the nominal exchange rate today changes in response to changes to these three given quantities? So let's start with an increase in the US interest rate. So if US interest rates increase, holding everything else in place, that's going to lead to a lower exchange rate, which means that the dollar appreciates. Remember that a lower value means a stronger dollar, means that the dollar appreciates. It takes fewer dollars to buy 1 euro. So if we keep the interest rate in Europe the same and beliefs about future exchange rate the same, an increase in the US interest rate will appreciate the dollar. That's going to be our first result. Second, let's look at changes in the interest rate in Europe. This is our initial equilibrium in the Forex market before any change. Now I'm going to look for an increase in the interest rate in Europe. So we have to see what that will do to dollar returns to European deposits on impact. So again, UIP is telling us that this relation has to hold. So now we are increasing the interest rate in Europe. For the same expectations of our future exchange rates and for the same exchange rate today, that will tend to increase the return to a European deposit when expressed in dollars. So that should be a shift to the right of the curve. We can also double check that using here where we solve for the nominal exchange rate. So if the European interest rate increases, that means that the denominator overall decreases and the nominal exchange rate should be higher. So the new UIP curve will be either to the right or up, however you find it more intuitive, but it's going to be to the right and up. And then as a consequence, the nominal exchange rate will increase. That means that the dollar depreciates. A higher nominal exchange rate means that it takes more dollars to buy 1 euro. The dollar has weakened, so it's a depreciation. Finally, I want to look at the consequences of expecting a weaker dollar in 1 year's time. So if I keep interest rates the same, but instead think about a weaker dollar in 1 year's time. That again will shift the UIP curve up and to the right. So the same shift in the curve can come from expectations of a weaker dollar in 1 year's time, or from higher interest rates in Europe. So the conclusion here is that if we expect the dollar to be weaker in 1 year, all of a sudden we come to expect the dollar to be weaker in 1 year, that will make the dollar weaker today, immediately. Notice that if the interest rates stay in place, expecting a weaker dollar means that the dollar must weaken today proportionally in order to keep this ratio constant. So these are the three comparative statics we need to be able to describe in the foreign exchange market, either increases or decreases in these three shifters. When we turn to our full diagram for the exchange rate overshooting result, that's going to be our bottom line in this chapter. The Forex market will be the top quadrant of this diagram. So the top quadrant will be the Forex market, and the bottom quadrant is the money market. This is based on the LM curve, whereas the Forex market is based on the UIP condition. And the way these two things connect is through interest rates in the US. So the way to think about it is that the interest rate in the US will be determined by clearing of the money market, and in turn the US interest rate, given interest rates, given the interest rate in Europe and beliefs about future exchange rates, will determine the nominal exchange rate today.